How did you respond to the weak dollar policy of Mr. Mnuchin, the president's adjustment to an ultimately strong dollar policy, and how does that fold into what you do unconstrained every day at Janus Henderson?
Well, Tom, I don't listen too much to President Trump or Mnuchin in terms of what policy they want. I think they speak with forked tongue or with different scenarios in order to please the market. I think what's important in terms of the dollar, and we know the dollar's been down 10% basically over the past 12 months relative to other currencies, is the budget deficit. If we're moving to $1 trillion,
yes,
that basically scares foreign investors in terms of holding dollars, because it means that the fiscal situation is deteriorating. So I think I would pay more attention to perhaps the success or lack of success of the infrastructure program advanced last night, and the fact that even without that, we're headed towards $1 trillion in terms of a deficit, and a weak dollar is probably what we should expect as opposed to a strong dollar.
So within that, a weak dollar and higher yields, maybe up to a bracketed 2.9%, 3% yield. Does Bill Gross just assume more volatility for investors in the next 12 months?
Yeah, I think a little bit more, Tom. Certainly on the stock side. I mean, the VIX got so low, down to about 9, and now it's moving appreciably higher. On the bond market, too, volatility got low. I don't think we're in a period of time in which volatility spikes significantly higher, because central banks are still in control. And if things got out of hand in terms of yields, or out of hand in terms of lower stock prices, then the Fed probably wouldn't increase interest rates by the expected 3 or 4 times. I simply think they're going up by 1 or 2 times in 2018, and that should dampen volatility significantly.